Hi, everybody, and welcome along to the Mint Monthly Update for the month of November for our single sector funds. Today it's myself, David Fyfe, Portfolio Manager at Mint, as well as John Middleton, who's joining me as fellow Portfolio Manager as well. Just rolling through to a chart of interest I thought I'd start with. I do find this quite fascinating, but it's really the chart on the left. We are looking at the number of consented dwellings by region, but on a per capita basis. The reason I find this quite interesting is just seeing where the amount of growth is occurring greatest. And of course, probably not a lot of surprise to a lot of people is the north versus south sort of difference at the moment, which, as you can see on the chart there in the red, this year, especially on prior years, the Canterbury and Otago region is certainly strong and growing well ahead of the rest of the nation. Unsurprisingly, places like Wellington are not particularly great, but interesting to see in the last update over the last few weeks, we have actually seen Auckland as well starting to rebound, and as a nation, New Zealand's consents are sort of back ahead of where they were the last few years now. As we always say, consents don't equal work, and again, we'll see how much of this actually comes to fruition. But interestingly, I was actually down in Christchurch last week visiting a few residential developers, manufacturers, as well as some transport businesses just to get the lay of the land down there. And again, they seem pretty busy in a way, but it's interesting to note a couple of comments. One is price sensitivity to residential purchases. There's certainly a bit of a tightening of the belt that's gone on down there, and also the willingness and the ability to borrow from banks has certainly seen people pretty tight at certain price points around Christchurch. And again, one of the interesting comments from one of the large developers we saw was very much around it's not just what people are building, but where as well. And we are sort of seeing a lot of the multi-res sort of townhouse build. I grew up in Christchurch, and it certainly looks like there's a lot going on at the moment. And the developer we saw has actually pivoted away from those to very much single sort of detached housing, but very much on a smaller land sites so they can get to those price points. So as we know, cost to build is still reasonably challenging. And this large developer also made comments along the lines of they're trying to push back on any price increases going through. And we know with the Iranian sort of pressure on the price of fuel and diesel, there's certainly been a bit of pressure for a lot of manufacturers. And, we are still hearing that same story that it is challenging out there to get price increases through. Chart on the right's more of an interesting one as well, where we are looking at non-resi building, and we've sort of heard from Fletchers and a few others that has been a challenging category. And so not unsurprisingly, it has tended to drift off across the board there. There's a few office buildings looking to be built, but and education ticking up. But again, a lot of these are soft and not looking particularly rosy. And again, these are just consents and not actual work. So with an election coming up, I'm sure we'll hear a bit more around potential infrastructure and other commercial developments that may be pushed ahead. But again, these have a long lead time, so we may not actually get activity from these sectors into the calendar 27. So we'll wait and see. But it's certainly something to keep an eye on. And then just for the local market, positive return. And in fact, for the year, for the last 12 months to the end of July, is now up almost 7%. So then, the New Zealand exchange has started to see some positive numbers. And again, the large caps did a lot of the heavy lifting, where we saw some pretty good moves from names such as Fisher & Buckle Healthcare, etc. But main freight was really the star of the month, and it left that to almost the last day of the month with its AGM update. Now, the picture on the right there is showing the profit before tax chart year on year for this AGM update, and it was a massive big win for main freight, up 78% profit before tax year on year. And there's a few different reasons what made that up. One, of course, being that last year was a very challenged period. They hadn't sort of been able to pass through cost inflation at the time. And again, volumes were rather muted across the board. Now, roll forward to this year, what are we seeing? Well, the transport business, especially in New Zealand, has been particularly strong. Certainly seeing some operating leverage coming through there for sure, as well as just volume recovery, a bit of confidence in the economy. Similarly, in Australia, we're still seeing some strong numbers through there. Both Aussie and New Zealand has been market share gains as well. But even in the slowing Australian economy, it's still looking at more than double-digit returns. The troubled childs of the Americas and Europe for main freight have also looked like they're turning the corner. While off a low base, they still are doing particularly well, and something to keep an eye on, especially for the future of this business in the long term, as we sort of do see this main freight business as a strong grower in the long term. In terms of other names out there we saw over the month, names like Port of Tauranga and Somerset certainly had a more challenging month as well. I think that was probably a function of what we saw in terms of the OCR tick up again, with rates making it a bit more challenging for borrowers and also for transacting in the market. which is also an interesting piece. Infratil also sort of came off its highs and it has just sort of been bouncing along. Interestingly, referring to Infratil, but more recently, Contact Energy with its result out this morning. We actually saw we tie up there between Contact and one of Infratil's assets, CDC, which is a data center developer. And the interesting piece there, of course, is that they're looking to potentially move ahead with a project in Stratford, or at least plan for. And Contact have partnered with them to potentially build some solar and battery of some reasonable scale, because they have their former gas combined turbine out at Stratford. So, of course, you've got I guess, a pipeline into the market, to the grid, ready to go. So that certainly helps with accelerating data center developments. And of course, that is a very hot topic at the moment, one we could dwell on in great detail, but it's, it is something that can create a lot of jobs for New Zealand, and also help support future generation development. I think that's the key piece, as long as it's additive, but it's something we're keeping a close eye on. So that was a nice update today. And of course, Contact numbers, unsurprisingly, were in line with the expectations, which is a great outcome to see. I will now pass on over to John to go through the Trans-Tasman Fund and property.
Yeah, thanks, Dave. So again, echoing Dave's comments, good to see Australasian markets up in what was a down month for markets in general, partly due to basically heightened concerns about Hormuz again, basically restricting access to the Strait, and also oil prices bouncing, and also because of rate rises, which happened in the period. So, nice to see a solid performance in New Zealand in particular. Australia was also up, largely due to the oil companies having a bit of a bounce. I would say July was a bit of a sort of reset month, in the sense that a number of the stocks which did well in June actually gave a little bit of that back. And if you look at the Australasian negatives, Telex and SRG both gave back a little bit of their performance last month, bearing in mind they were both up 27% in June. So still net up, but we gave a little bit of that back. In terms of news flow, a reasonably quiet month, considering we're sort of in that limbo period ahead of results, which kick off in the second week in August. We did get actually a positive comment out of Fletcher's. To be fair, Fletcher's has been one of the stronger performers over the last couple of months. More recently, that's been because management have been delivering on promises, essentially saying we will get rid of those businesses which are not making proper return on capital or are non-core, and they've managed to achieve that pretty well and ahead of expectations, which has allayed concerns about the balance sheet. And in July, we actually did get a bit of positive news, I think, for Fletcher's and country, when essentially the government agreed to contribute 60 million out of 150 million further investment in Fletcher's concrete works in the North Island, Golden Bay Cement, which should ensure that asset remains operating through 2040. I think a sensible move here. Essentially, Fletcher's is competing against direct imports for cement out of Japan, and that's fine at face value. But where Fletcher's benefits the country is it can use waste, industrial waste, particularly things like car tyres, in the manufacturing process of cement, and hence recycle elements from New Zealand that imported cement can't bring with it. So I think a sensible move from the government, and certainly consolidates Fletcher's position in cement for the next decade or so at least, bearing in mind that cement is one of the higher earning businesses for Fletcher's. Outside of that, as I mentioned, we did get a 25 basis point hike from the RBNZ. Again, largely as expected. The interesting thing going forward is we're expecting another 3 or 4 rate rises over the next 12, 18 months. Again, we're probably slightly more, would be more surprised if we get to see all 3 or 4 of those hikes, given the underlying economy. And then finally, just to flag that obviously we did start to hear rhetoric about tariffs once more, just remembering that a lot of the tariffs that President Trump imposed as soon as he came into office have now been basically proven to be unfounded and some have been returned. And on the back of that, he's basically created another bunch of very similar tariffs to come in place over the months ahead. So not a huge amount of news flow. Again, within the funds, we did continue to add to a few positions. Basically, Auckland Airport, we added net wealth to the portfolio, and we also continued to add to Southern Cross and funded that, taking a bit of profit out of Infratil and Telex. The chart on the right is really sort of readying everybody for reporting season. This is essentially a bit of work which looks at how share prices reacted on the day of results over the last 20 years. And again, at the beginning of my tenure in the markets, you know, a 5% move up or down on the day was considered extreme. Roll forward today, and a 10 to 15% move is probably the norm. The reality is that I think you get punished more on the downside today than benefit on the upside. But again, going into reporting season, we do expect volatility to remain. The good news is we have gone through the June year end, where a couple of people updated the market. We talked about this in previous months, and for the most part, the news was good, i.e., you know, not as bad as feared. Yes, there have been a couple of minor downgrades, but for the most part, I think our businesses have managed their operations well and in line with guidance. The only point I would flag is, you know, clearly in a period of ongoing uncertainty, I'd be very, very surprised if outlooks were too optimistic, particularly with the election coming up in the next couple of months. Moving across to the property fund, again, you know, the property sector is impacted by basically moves in long-term interest rates. The fact that we hiked interest rates in New Zealand in the month meant that the property sector underperformed the market. And, you know, not a massive surprise there. In terms of specific news flow, I think the one probably interesting thing to focus in on was Precinct actually got approval for basically starting work or consenting work to bring about the downtown car park redevelopment. I mean, this is essentially knocking down the car park right by the waterfront in Auckland and replacing that with a couple of towers of basic mixed use, either office or residential or even potentially a hotel. So major new addition to the waterfront and the office outlook. I suppose the interesting thing there is that it is a decent amount of investment in what remains a difficult, you know, underlying economic environment. Yes, I mean, it will probably take at least 6 months to 12 months to knock down the old car park, even before we start to build the new. So it will be a 3 to 5 year development. But, you know, the question remains whether we do need any more office product in the current market. And I suppose when you drill down into that, the interesting thing is that, you know, Precinct is really the premium office owner in the market. PwC Building did, you know, rebase rates higher, and again, that is a marquee asset which people want to be in and remains with good occupancy. And I suppose that's the point I'd note, which is at the premium side of town, vacancy remains pretty low, basically at about 5%, and it's remained broadly there through basically the COVID and beyond. The real issue in the office market in Auckland and in general is the sort of the B/C grade office, where you have occupancy of 25% plus. And I suppose that is the interesting thing here, is that while PwC may well be able to get tenants, one possibly being ANZ, for the downtown car park development, you know, the reality is that there will be a cascade down into that lower grade office market, which I think will weigh on those areas as well. So it'll be fascinating to see what Precinct says about this going forward. You know, the other thing we've been waiting for from them is a capital partner. In terms of a 600 million plus development, you know, it'd be helpful to see someone coming in and helping them pay for that. But, you know, it will be revealed in a week's time when they report results. Other news flow, bit of bad news from New Zealand Rural Land Co. One of their tenants, Kiwi Crunch Farms, which accounts for about 6% of their rental income, went into voluntary receivership. Flags that, again, there are still some economic pressures within the New Zealand economy, but obviously, not great for them, and they will need to, will probably receive some losses there and need to find a new tenant for those assets. We did talk about Winton last month. Just looking ahead to reporting season, we do have 3 companies reporting. We've talked about Precinct. We also have Vital Healthcare and PFI as well. So Vital focus on healthcare. Again, will be interesting to see if we have seen any fast track hospital development in New Zealand. But the good news is that it feels like the Healthscope saga in Aussie looks to be coming to an end, and hopefully those assets will be refinanced and operating properly, which will take, I think, a bit of a headwind from the healthcare part of the property market. Finally, again, Northwest, who is a major shareholder, could well sell down some of their stock post the result, so just be aware of that. And then finally, just looking at PFI, again, the industrial focus of the assets. Technically, we would expect a little bit of a vacancy increase, but fundamentally, we think the underlying business is solid. What will be interesting there to note that the cost of construction of new warehouses has reduced materially, largely due to subcontractor fees reducing. So far, PFI has been very restrained in terms of starting new developments. A number of its non-listed peers have basically built quite large warehouses with no tenants at the get-go, and those warehouses remain empty, which has increased the vacancy for the market. Certainly PFI historically has got a large anchor tenant before it decides to embark upon greenfield development, and we think that would still be the case. Looking to the chart on the right, I mean, this is hopefully a good way of explaining how we look at the property sector and assets, and our view of assets within the sector. This is essentially looking at AFO payout, i.e. the yellow line is how much of your cash flow you are spending. If you are spending more than 100%, you are spending more than your operating or free cash flow for the business, which is bad news if you look, or certainly means that you're highly unlikely for your dividends to increase over the short to medium term. If you are below that dotted line, then you are spending less than your free cash flow, and there is scope for increasing that dividend payment. What is being done here is looking at maintenance cash flow, or CapEx, in different ways. I mean, one of the bugbears of the industry is everyone deems or terms maintenance cash flow differently, but if we allow for 25 to 50% of the residual spend of AFO to increase, this pushes a number of the players over that 100% payout ratio, and means that this is areas where we see risk to the dividend. So we're comfortable owning things like Goodman New Zealand, PFI, and KPG, where payouts are below that 100% ratio, even allowing for a different interpretation of CapEx. And we are more saying, well, we are less confident about the growth in dividends for things like Argosy, and also things like Precinct, if they do undertake to go ahead with the downtown car park. Anyway, I hope that helps and is of interest. We look forward to speaking to you in a month's time, when we will have had the June reporting season period, and we will be able to tell you how that went. If you have any questions, please, as usual, drop us an email at info@mintasset.co.nz. Otherwise, we appreciate your support and look forward to talking to you in a month's time. Cheers.